The accounting equation is the foundation of the science of accounting. According to the accounting equation, assets equal liabilities plus owner's equity. An asset generally is anything in a business that has some sort of financial value and can be converted to cash. The products you have stocked in your warehouse are assets. They're converted into cash as you sell them. Assets come in two different flavors. These categories represent how quickly assets can be converted into cash. Current assets are assets that can be converted into cash within 1 year. Assets that you can quickly convert into cash also are known as liquid assets, and the speed by which you can convert assets into cash is called liquidity. Fixed assets are assets that take more than a year to be converted into cash. Here's a list of the most common kinds of business assets. Cash includes good old-fashioned money and money equivalents such as checks, money orders, marketable securities, and bank deposits. Accounts receivable represent the money that your clients and customers owe you for purchasing your products or services. When you allow a customer to buy your goods today and pay later, you're creating a receivable. If you work strictly on a cash basis, you don't have any receivables and this item will be zero. Inventory. Inventory comprises the finished products that you purchase or manufacture to sell to customers, as well as raw materials, work in progress, and supplies used in operations. If you run a grocery store, your inventory consists of every item on display for sale in your store: the carrots, the tubs of margarine, the boxes of donuts, and so on. Prepaid expenses. When you pay for a product or service in advance, you create an asset known as a prepaid expense. Examples include a prepaid maintenance contract on a typewriter, an insurance policy with a 1-year term paid in advance, and an agreement for security alarm monitoring paid in advance on a quarterly basis. Equipment. Equipment is the wide variety of property that your organization purchases to carry out its operations. Examples include desks, chairs, computers, electronic testing gear, forklifts, and lie detectors. Real estate. Real estate includes assets such as the land, buildings, and facilities that your company owns, occupies, and utilizes. Some companies have little or no real estate assets, and others have sizable ones. Liabilities. Liabilities are money owed to others outside your organization. They may include the money you owe to the company that delivers your office supplies, the payments you owe on the construction loan that financed your warehouse expansion, or the mortgage on your corporate headquarters building. As with assets, liabilities come in two flavors, each representing the amount of time it should take to repay the obligations. Current liabilities are to be repaid within 1 year. Think of the money for next week's employee paychecks, the payment your company owes to your office supply business, and payment on a short-term loan from the bank. Long-term liabilities are to be repaid in a period longer than 1 year. Think the payments on the company delivery van, the mortgage on the company's distribution facility, or the money owed to holders of corporate bonds. Here's a list of the most common business liabilities from both the current and long-term categories. Accounts payable. Accounts payable are the obligations owed to the many individuals and organizations that have provided goods and services to your company. Examples include money owed to your computer network consultant, your local utility company, and an out-of-house advertising agency that your marketing department uses for ad campaigns. Notes payable. Notes payable represents loans made to your company by individuals or organizations, such as banks and savings and loans. The notes could be anything from an IOU promised to an individual for a small amount of cash to a multi-million-dollar loan secured from a large bank. Accrued expenses. Sometimes a company incurs an expense but has no immediate plans to reimburse the individual or organization that's owed the money. Examples include future wages to be paid to employees, interest due on loans, and utility bills. Bonds payable. When companies issue bonds to raise money to finance large projects, they incur obligations to pay back the individuals and organizations that purchase them. Mortgages payable. When companies purchase property, they often do so by taking out mortgages, long-term real estate loans, just like the one you may have on your home, secured by the property itself. Mortgages payable represents the mortgages that an organization has on all its properties. Owner's equity. Owner's equity is the money that remains when you take all your company's assets and subtract all your liabilities. Owner's equity represents the owner's direct investment in the firm or the owner's claims on the company's assets. Another way of expressing a company's owner's equity is its net worth. Net worth is simply a snapshot of your company's financial health for a particular period of time. Here are the two types of owner's equity. Paid-in capital, the money that people invest in a company. When companies such as IBM, Ford Motor Company, or PepsiCo offer to sell shares of stock to investors in a secondary offering, new stock, or when companies do an initial public offering, go public for the first time, investors provide paid-in capital to the companies when they pay money to buy the stock. Retained earnings. A company's earnings that are held within the company. The money gets reinvested, not paid out to shareholders as dividends. Although owner's equity generally is a positive number, it can go negative when a company takes on large amounts of debt, for example, to acquire another company.